All right, guys. Today I have a podcast that I would like to share with you. I've tried to do this a couple times over the past few weeks, but it always ended up being too long and a bit inundating, and sometimes I would lose my train of thought. So um, I'm basically going to try to explain to you the secret of the markets. Um, well, at least the secret of the NASDAQ 100, the S&P 500, and the Dow Jones Industrial Average, as well as a lot of the other major indices around the world. Now, different countries have different performance. I consider myself with the NASDAQ 100, but a lot of the companies that are in the NASDAQ 100 are also in the S&P 500. And as I'm sure you know, generally speaking, that the Dow Jones, the S&P, and the Nasdaq tend to move very somewhat similarly. I won't say very similarly, but somewhat. The S&P and Nasdaq move a bit more similarly, and then the Dow is a little bit different, but they all will tend to go up in the long run. And that's what I'm going to get into today. Why do these indices go up in the long run? There's a very simple explanation for it, and Wall Street analysts and news media will try to obscure this. I don't know if they know what they're doing, but whoever's calling the shots for them knows what's going on with that. But there's one reason why the indices go up in the long run. Only one reason. Okay, and so I'm going to get into that and tell you what it is, but I'm going to do it in the, I guess, the more roundabout or the long way. So we'll get to why in a second, and once I explain why they always go up in the long run, I think it will help you feel a lot safer with your trading or your investing. um, you'll have a lot more conviction uh, that you can put behind your trades, and you can maybe make some corrections to your trading approach. Okay, so first step is if you're struggling as a trader and you're trading Nasdaq or NQ, ES, YM, um, the what you should already be realizing by now after this 2 minutes I've been talking is that you should take short positions. Okay, it's pretty much that simple. If you only take long positions on those indices, you will win money in the long run. Like your account will grow. Um, how smart you are about your strategy, or the kind of analysis that you do to try to actually carve the biggest profit factor out of a strategy that's trading, taking long positions on those things, whether you're day trading, swing trading, position trading, or just long-term investing. Depending on where you're buying and stuff like that, your profit factor can be higher or lower. So that's what's going to be up to you. But I'm already giving you, this whole thing is going to be like at least over half the answer of all the problems that you have in trading. So let's get into why you can trust that it will keep going up in the long run. And what would be the signal that it's actually the market would crash, not just for a year or two or three, but actually crash and completely, like, what would it take for the S&P 500 and the Nasdaq 100 to actually go out of business, essentially? I mean, and think about that. Think about how hard that is. That would have to mean that a lot, like basically every American company would have to fail, right? Because the indices are weighted by the strongest performing companies, right? The companies that have the best earnings and have the big grow to be like a mega giga company, those will take the top of the weighting of the S&P and the Nasdaq, right? And the Dow. So long as American companies, the big American companies are performing relatively well, again, you can trust that those things will go up in the long run. But why are they going up in the long run? One word: inflation. Now, this may come as a shock to some of you who read news media or listen to opinions that are on Reddit about trading or on social media. Wall Street would do anything they can do to try to trick you in this regard so that they don't have to share their profits with you. But there is a direct correlation between inflation and the inflation, cumulative inflation, and the trend of the S&P 500 and Nasdaq 100. Okay, so I'm telling you right now, inflation makes the index go up. So if you believed otherwise up until this point, learn to forget it, okay? And I'm going to explain why and how it makes it go up. It's very simple once you understand it, but it took me a while to figure it out because, again, the people who are up at the top behind the closed doors, the freaking satanic Illuminati shit, um, which is real, by the way, but we don't have to get into that. And I'm not going to get into that stuff. But the markets are controlled to a degree. Um, but also the trend will always continue up in the long run because of this. Okay, so anyway, what is inflation? Inflation is the result of one thing only, which is fractional reserve banking. Um, and fractional reserve banking is basically where institutions, whether it be like the government, with when we're talking about the Department of the Treasury, working in conjunction with the Federal Reserve, they are the biggest offenders of this. But also big banks are doing this too, which is you're lending money that you don't have and collecting interest on. That, in short, that's what it is. Okay, so banks are required to keep 10% cash reserve on hand, meaning that they are supposed to have the theoretical 10% of their all their assets has to be liquid, meaning it has to be at banks able to be withdrawn. So banks are required by law to have 10% of their reserves withdrawable at any time. So that means if you deposit $100 in a checking account or savings account, you that means the bank theoretically has to keep at least $10 of that, and they can loan the other $90, right? Okay. However, just going to throw this out there. What if they said that $100 that you put in, what if they said that was the 10%, and then they loaned $900? Because your $100 is in the bank, right? So they technically have 10% cash on reserves, right? If they keep $100 and they loan 900, they can cough up that $100 if they have to, because it's 10% of what they're lending, but they have all of it. Okay. Now, I'm not saying banks are lending 900% of their assets, okay, because they're not lending that much. But what I do know is that banks are lending more than 100% of their assets. Okay. So if banks are lending more money than they actually have, where is that money coming from? Think about it. Where is it coming from? Fucking nowhere. Okay, so if you lend money that doesn't exist because you want to collect interest on it, which is greedy and fucked up, what's that going to do? It's going to circulate money into the economy that previously didn't exist. Okay, and what that's going to do is dilute the existing supply of currency. Now, a big bank's doing this and lending it, they are inflating the currency a bit. But where it really gets bad is really the Federal Reserve and the Treasury, because they are printing, quote unquote printing, because they don't even print the full amount anymore. Most of the currency now exists only electronically, right? If you need to withdraw cash from your account, like there's cash that they can find, but like there's more there is more money that exists, especially like we're talking U.S. currency. There is more currency that exists than actual physical dollars. So for every, I don't know the exact number, but for every actual physical dollar that exists, there's probably like five, $4 or $5 that aren't actually physically existing, but they exist in the form of people being in their bank accounts, or it originated with the government printing it. So it exists electronically, but they don't print that much money because they know that basically they know exactly, not exactly, but they know roughly how much physical currency has to exist compared to how much electronic currency exists, right? So it's not like all existing currency has to be liquid at one time, because it's usually just being stored in people's bank accounts, right? And stuff like that. But yes, it's a fact. Most money, well, I don't know if the answer is most, but I'd say at this point it is the majority. Over 50%, I would think, of currency only exists electronically. And the system depends on the fact that not everyone's going to try to make their cash liquid and like actually have it in physical cash all at the same time, which is kind of like this fractional reserve banking, same type of thing, same type of logic, which is that basically create money out of thin air, assume that not everyone's going to need it all at the same time, and it won't be an issue for everyone, right? So, but okay, so here's another question though: why does fractional reserve banking happen? Now, obviously, I've already touched on a perk from it. I didn't say it was a perk, but a perk is that you're collecting interest on money that doesn't exist. So you're basically generating free money out of thin air. Now, the consequence of that is, like I said, it dilutes the existing supply of currency. So for every dollar that is created out of nothing, that makes each existing dollar worth that percent less, right? So if $1 is 0.00001% of the value, that means that every dollar you create makes all existing dollars decrease in value by that same percentage. Okay, so basically, what that means is that cash holders are getting poorer over time. The purchasing power. This is what it is. The purchasing power of the dollar is going down every time that an additional dollar is created. And if you don't have to believe me, but if you want evidence that money's being created out of thin air by the government, which it happens a little bit differently than fractional reserve banking on a private bank scale or a public bank scale. But in terms of government, what they do is basically Congress decides that money needs to be spent. They then, once it's approved, the Treasury looks to print the money, basically goes, we don't have the money. They go to the Federal Reserve. The Federal Reserve writes them a blank, basically has a blank check that they can write. And they write how much that Congress has been approved to spend, and then they approve the Treasury to, I guess, print the money. It basically works like that. It's probably oversimplified, but it's if you understand it that way, you're basically getting the gist of it. That the Treasury and the Fed are working in conjunction to control the supply of money and also to create new currency supply. Uh, so anyway, as I was saying, why is this happening? Well, first off, I said collecting interest on nothing is pretty nice, but also it destroys debt. Okay, if you owe $5,000, but inflation makes that $5,000 in 5 years from now, it's worth what $2,000 is worth right now, and you get that loan out at a low interest rate, guess what? After 5 years, you pay off that loan, and if you're paying $5,000, but it's been inflated, so you're really only paying $2,000. That's good for you, right? So the government, so you can look at a website. It's called usdebtclock.org, and the government that will show the total debt. Okay, so you see the government debt is like 34, $35 trillion, which is a lot. But the thing is that's not even the full amount of the debt because it'll also say total U.S. debt, which includes the government's debt and all the citizens' debt, and our debt is now over $100 trillion. Okay, well, ask yourself this: who who is owed that $100 trillion, right? Who what entity has that $100 trillion that was loaned out to everyone? Well, the answer is nobody. Again, it's because of currency supplies being created out of thin air. That debt is the hole in the ground that was created in order to make the currency exist. So what you're really looking at there is that $100 trillion have been created out of thin air. Well, it won't be that full amount, but whatever, basically when currency was backed by the gold standard, that was, I guess, its true valuation. As soon as the gold standard went away and each existing dollar wasn't backed by a specific amount of gold, the all the dollars that have come into existence since the gold standard was removed is basically created out of thin air. All the dollars that existed before then are supposed to represent gold that exists. But if you think about that, that doesn't even really make sense either, because if it represents gold that exists, but the gold could be utilized as well as the cash, you're basically doubling what that gold is worth by having gold and then having an equal amount of cash that exists before to represent the gold. But now that there's no gold standard, that cash that existed even when it was backed by gold is now no longer backed by gold. So anyway, in a roundabout way, back to what I first said about this is that basically $100 trillion created out of thin air. Okay, it's owed to nobody. And that's the evil genius of the US government is they literally owe $100 trillion to nobody, but they still owe $100 trillion. Okay, but again, if they have debts or if they have this debt that's created and there's interest that has to be paid off, which they're not really paying anyone, so they don't really have to pay interest. But, there are, I'm not going to stand here and act like other countries don't own a portion of that debt. Like some of that debt, it's not $100 trillion, but some of that debt is owned by China, right? So the United States has to make interest payments to China on a specific amount of the debt that's owned. And there are some other countries. But anyway, if they keep creating more currency supply, they're paying back less and less of those debts as time goes on. So it's basically this really selfish way of kicking the can down the road. Okay, now, that may not have been the most thorough or PhD level explanation of inflation and currency supply and fractional reserve banking. If you really want to understand that stuff better, you can go look into it yourself. Okay, I'm just saying it off the top of my head. Okay, but the gist of it is that the currency supply is always increasing. There's always more money being created. So how does that pump the market? Well, public companies that represent those that the stock indexes are comprised of. They're comprised of, NASDAQ 100 is comprised of 100, or I think it's 101 right now, of the biggest tech companies in the United States, and it's weighted by how powerful they are. So it's really mostly about the top like 7 to 10 stocks in that, right? And I think the top 2 or 3 actually are like 40%, or I think no, they can't exceed a certain amount, but they still manage to like weight it heavily. So like right now, it's basically Nvidia, Apple, Microsoft, Google, Facebook, that kind of thing, right? Anyway, these companies sell products. Well, what happens when inflation happens? What happens to the price of products that you buy? Price of goods and services. It goes up, right? Because it costs more dollars to buy the same thing. Each dollar is worth less in purchasing power, so you need more dollars to buy something. Thus, the price is higher, right? You probably already see where this is going now. By increasing the supply of currency, you're increasing the valuations of these companies because the stock prices themselves are not inflation adjusted, and the prices of the goods are not inflation adjusted. When you see an iPhone for $1,500 or whatever much they cost now, but iPhones used to cost what? I don't even remember. The first iPhone probably cost like what, 400, $500. It costs the same amount of money. It's just because so much currency supply has been created since the first iPhone came out. Now an iPhone costs over $1,000 because there's over doubled the supply of existing currency now. The value of the item is the same, and this will help you understand that. As the value of all goods and services now, they fluctuate, but generally speaking, in the long run, the price of let's just say anything like a suit. Okay, let's say you own a suit and tie, because let's say you work a high paying job, you have to wear a nice suit and tie. The amount of money you have to pay for a suit and tie now versus 300, 200 years ago, or whatever a suit looked like back then, it's actually about the same. The dollar value is much higher because the supply of the currencies increased. But if you adjusted for inflation, it costs the same. If the price of a nice suit costs the same now as it did 2,000 years ago, it's just that of inflation is obscuring that fact. So if they keep printing currency, and the currency increases the prices of these non-inflation adjusted stock prices, their prices are going to, in the long run, continue to go up. Now, there are major bear markets that you can predict using Michael S. Jenkins techniques, which I used to go into that more earlier on my channel. I don't really do that stuff anymore, um, because I've determined that the edge in the NASDAQ is so big to the upside. I don't necessarily have to predict when a bear market's going to happen. I mean, if I can, sure, that'll help, but I'm not going to be jumping around trying to figure out how big the bear market this year is going to be, because every year it seems will have a little bit of bearishness here and there where the NASDAQ declines like 5%, maybe 10%, but usually the NASDAQ is gaining over 10%, 15, 20%, even more per year. So which side are you going to bet on? Are you going to try to pick the recession that happens every 5 to 10 years and it loses 20 to 50% of its value, or are you going to bet on the other 4 out of 5 years, or the other 8 to 9 out of 10 years where there's no bear market and the index goes up over 100% during that period? Which one do you want to bet off? Where do you want to make your career? To me, it seems pretty obvious that you shouldn't fight the trend in that area. And so I'm not going to. This video isn't me getting into my specific trading strategy, which is how I'm up over 400% on the year now. We're actually not quite almost 400%. Sorry. The point is that whatever you're going to do, you should just keep in mind that the NASDAQ will continue to go up in the long run because it has to, because literally the forces of inflation will push the market up. It doesn't mean there can't be recessions. But the recessions themselves may be engineered by the powers that be in order to knock people that are uninformed out of the market, scare them into thinking that it's not going to keep going up, or it could be more just natural ebb and flow of the market. But the point is that there's a thing in trading called mean reversion, which is that you tend to bet on the average, right? And if it goes way outside of the average, you can expect it to return towards that average, right? To trend back towards it. If it goes outside of its normal boundaries, If we're talking about it like it was a butterfly effect, Lorenz attractor, if you know about chaos theory, if it's curving, if it's kind of straying from its natural curve, you can expect it to begin to return to the natural curve sooner or later, right? Well, the natural curve of the Nasdaq is for it to go up, right? Like think about this: if a given not if you adjust for inflation, if the given price of an asset is just flat, basically, there will be fluctuations, but it's essentially flat in the long run. Then that's its mean. Its mean is to go flat. But if the Nasdaq is being pumped up by inflation, then the mean it will always return to that mean of trending up as long as inflation continues. So okay, so now when would you actually take a short position on the Nasdaq? If the Fed and the Treasury decided to destroy supply of currency, which I honestly don't think they ever will do that, because why would they want to make their debts worse? Sorry, their debts worth more. They want their debts to be worth less, so they have to pay less money on their debts, right? So they'll always continue inflation. But if for some reason they began to deflate and deflation happened, then you would short the NASDAQ because the physical, I'm just using like a physical analogy, but the forces that actually drive the market would drive down the prices of goods, because if you started destroying the supply of currency, each existing dollar would be worth more, thus the prices of goods would fall, right? So very, very simple economics. Like this is like supply and demand 101, just applied in the way that you're not told to apply it. It's very obvious once you see it, but the textbooks don't teach you the implication of inflation on the stock index, right? You have to figure that out for yourself. And so the big boys in Wall Street, the people who really make a lot of money in the long run, they know this. Okay. And so, in my opinion, the difference between a profitable trader and an unprofitable trader is this knowledge. And now, knowing this, knowing that you have a market or an asset or an index, whatever you want to call it, that will always go up in the long run, you know what to trade now, too, because you could try to trade foreign exchange currencies. And my best guess for the bias of those is that if you compare the interest rate trends on them, that will determine the direction of that currency. Also, understanding basically, you have to understand the rate of inflation of both currency pairs, of both currencies in the pair, and the interest rates, and then understand their trends. If you can understand the direction that both currencies separate interest rates are trending in, which is a little less important, but also understanding the rate at which each currency is inflating, the one that's inflating faster is weaker versus the one that's inflating more slowly, right? Most currencies will be inflating, and they probably will have somewhat similar inflation rates, right? But I'm just saying that if you want to get a bias for that. But honestly, why would you do that? Because the Nasdaq is a lot easier to trade than currency pairs. So, like literally, the easiest asset to trade is the Nasdaq because it will always be driven up by the top performing companies in the long run. And again, I know 50% drawdown can happen. Like the whole asset can lose 50% of its value or more. But again, something you have to learn about the way that kind of stuff works is that the Nasdaq has never gone to zero, meaning that even if it has a 60% drawdown, it will recover. And by, you know, a few years later, it's going to be double what it was at the top before that recession, right? So there's going to be years or periods of time where you don't make as much money betting long on the NASDAQ, but the times that you do make money betting long on the NASDAQ will far outweigh the times that you lose a bit or go sideways. And there are ways to construct a strategy of trading that will tend to mostly just go sideways, even when it's in a bear market. I won't get into that. You'll have to figure that out yourself. But anyway, I hope this is enough information for you to understand that basically everyone's been duped about the market, and that's why they can't make money trading. And the answer really is that easy, that the NASDAQ will just keep going up. So you can't be discouraged when a recession happens, because those recessions discourage all the noobs out of trying to buy the dip, which literally you should buy the dip on the NASDAQ. You should buy the dip on the S&P 500. Okay, and the NASDAQ's only been around, I think, since the 80s or 70s. But the S&P has been around for, I think, over 100 years now. You can look at the all-time chart of that. Compare that all-time chart to a chart of cumulative inflation. So the inflation rate right now, I believe, is somewhere around 3 to 4%, right? But that's the rate of inflation. So that means that inflation is accelerating at 3% annually. So it's still going, it's still parabolic, right? If you want to know the actual total percentage amount that the dollar has been inflated since session, which I believe it's inflated like something like 4,000%. Well, there the fuck is your answer. There's your answer for why is the S&P 500 going up. Just look at the cumulative inflation value and tell me, do you think that the thing that they've been doing for the past 100 years, once they implemented the Federal Reserve, do you think they're going to keep doing that? Do you think they're going to stop doing that, or do you think they're going to keep doing that? They've been getting away for it this long. They're going to keep getting away with it. This is the whole world economy is now built on inflation, and inflation siphons wealth from cash holders, and it keeps them poor, and it keeps the wealth in the hands of the wealthy who can control the supply of money and currency. So anyway, I hope this makes sense for you. If this is the first time you're hearing some of this stuff, it might not make a ton of sense right away, but like I've tried to explain it pretty simply. And you don't really have to understand that much of what I'm saying. All you have to understand is that NASDAQ go up. Like once you understand that what I'm saying means that that will happen, trading becomes a lot easier. It actually becomes a pretty easy thing. Now you have to carve out your edge. So are you gonna day trade, swing trade, position trade, or long term invest on that, or do a combination of those things? I day trade it. So what am I doing? I'm taking day trades that bet on the overall uptrend of the Nasdaq. The benefit from that of me is that I don't have positions on while I'm sleeping. Well, I do because I wake up, I put the position on, and then I go back to sleep. But what I mean is that I'm not exposed overnight. I'm only trading it during like the New York session, basically. And what I'm betting that is that in the long run, during the New York session, the Nasdaq will go up more than it goes down. So that thus I make money. And because I'm day trading it and I'm doing it on futures, it's leveraged. So even though the Nasdaq's up like what 20% on the year, I'm up almost 400% on up moves on the Nasdaq because I leveraged it, figured out my risk reward, my optimal F for the strategy. I'm not going to get into all that stuff, but basically because of leverage trading, I'm able to make 400% off of a 20% move, right? It, now the only I mean, I'm not going to get too into it, but I do, my stop loss is actually fairly tight. So that's the other thing about it because just being leveraged alone would expose me to almost as much downside as upside. But because I have a tight stop loss, my upside on my trades is a lot higher. So obviously, having a good risk reward on your trades too is really good, or having a high probability of winning, right? And that's a whole other thing I'm not going to get into, but risk reward isn't the only thing that matters. It's the risk reward coupled with the win rate that matters. And whatever percentage edge or whatever your win rate is above break even, the break even win rate for that risk reward, every specific any risk reward that you have that you want to frame has a break even win rate, right? A 1-to-1, what's the break even win rate of that? 50%. Okay, so if you have a system that has a 1-to-1, but you have a 53% win rate, that means you have what? A 3% edge. So mathematically, what does that mean? It means you're supposed to risk 3% of your account per trade. So whatever your edge above break even is the amount you risk per the percentage of your account that you risk per trade. But anyway, this has been informative 32 minutes for you guys, I hope, and stay tuned for more. But this is really useful information, so I hope it helps you.